Hey guys, today I thought I'd comment on some data out of CoreLogic. There's one thing to note since the start of the pandemic, and that is that uncertainty is the only thing that's certain in this environment. And I think that applies to the property market. A lot of the conversations I've been having with other business people, people involved in the property and the finance game, we're on the same page, I should say, in terms of there has been a lot of negativity. And I know for myself as a business owner, you kind of have to plan for the worst. But when you actually look at the property market, it's actually just business as usual. Nothing much has actually happened with the property market yet. All of this time there's been this negativity around the property market, and potentially that negativity comes into play. Sometimes the economy does have lags in it. But what I wanted to do today was actually go through a bit of the data and then just revoice where I stand on the property market. So the first one I wanted to look at was the Melbourne market, and partly because I'm in the Melbourne market, but look at how clear the actual cycles are here. So the annual change is fairly predictable in terms of you can see that it's cyclical, right? And actually right now it looks like it's hit the bottom and it's starting to cycle back up again. Now, what's interesting is if you actually go through and look at the other states, the picture doesn't look the same as Melbourne. And it actually gives you a fair idea of momentum. So Brisbane looking like it's going to come to the bottom of its cycle. Adelaide's still tracking down. You got to remember here, these are kind of holistic pictures for the whole state. So obviously within the state there's markets. Some markets are doing quite well and other markets will be doing not well. This is just an overall picture of the states. The next piece of data I wanted to comment on was the overall listings. Because the interest rates have gone up so much, overall borrowing has actually dropped. And a lot of people have thought, using some common sense, thinking, well, if people can borrow less, then the price of property is going to drop a lot. And borrowing powers have dropped 40-50% since the last kind of 12 to 15 months. Unfortunately, the market at the same time has reduced the amount of listings that it has. Like, I don't actually know the reason as to why the amount of properties on the market have dropped. I think potentially maybe people just understand at the end of the day that property is a finite asset and you're actually better off holding a finite asset over time. It's definitely playing a role in terms of the property market kind of being supported. Like, it definitely hasn't fallen through the floor. And the reason it hasn't fallen through the floor is there aren't all of these surplus amount of properties on the market because of the low listings, right? And what's actually happening is that if there's no oversupply on the market, there's no reason for vendors to discount their prices of their properties so much, because they know eventually they're just gonna move them at the higher prices. So at the moment, we haven't got those increased listings. Now, what a lot of people would have thought, say 12 months ago or 9 months ago, when we were getting those 0.5% rate rises at a time, would be that, okay, people are not going to be able to afford these interest rates. And what's actually going to happen is people are going to be forced to put properties on the market. We can clearly see here that's not the case yet. Now, I say yet because it could still happen in the future, but I think it's worth noting that things are uncertain. So what we thought 9 months ago, the bottom end might fall out of the property market, it hasn't happened yet. So that's kind of why we want to go through some of this data. And this slide just backs up the low listings. It's just another visual representation. And you can see there based on previous years and the 5-year average, which is the dotted line, there are a lot less listings on. Again, we could theorize as to why, but that's the reality at the moment. The next slide here, we've got some rental information, really confirming what everyone knows. Rents have been skyrocketing along with the inflation, so no big surprise there. The cities have gone up higher than regional areas. I don't want people to be confused here, but the regions still have a higher rental return. So whilst it's gone up less in the regions, say regional Victoria, for example, we can actually look here, combined regionals have gone up 6%, whilst combined capitals have gone up 11.7. I think it's worth noting the overall yields in capital cities like Melbourne especially were quite low over the past 5 to 10 year period. So it's playing a bit of catch up there, but at the moment your regions are looking a lot better. You can see that here with the next slide showing your combined regional average is 4.6% and your national or your capital city average is 3.7% for a yield, which I would not accept a yield of 3.7%. And the reason why a lot of people are accepting these yields of 3.7% is quite straightforward, and it's that they're looking for capital gain, which means they're speculating on price more than anything. I look at that and think that's probably not the best strategy. It's definitely not the strategy that I would use, gambling on capital gain. But hey, a lot of people love it. Okay, and the last slide here before I get into my overall comments on the market is this one of the actual finance picture. So it's a pretty straightforward one. This one on the left here, it's owner-occupied or investment lending. So you can see here, whilst we've had a massive drop-off, you've got to understand we had this spike in lending because rates went to basically 2% for owner-occupiers, which means that people could borrow a lot more. Obviously, a lot of people saw opportunities to upgrade their house, and some people were investing more. You can see that's peeled back kind of the last 12 months or so. By the same token, the overall debt hasn't crashed through the floor. Like, the overall amount of debt getting taken out is still relatively the same as what it's been kind of the last 5 or 6 years, barring those last couple of pandemic years. To be honest, I took one look and thought, oh yeah, that's fine. It's probably a bit higher than what I thought it would be, but based on what I'm seeing in the market, that's normal. But if I took the bull case scenario here, if I was on the side of the, if I was your average property investor that thinks the market's gonna go up, it is actually a bullish chart, because in the last couple of weeks we're getting lenders, we're getting talk in the financial areas of making money easy to borrow again. So what I mean by that, I think Westpac came out, a couple of small lenders come out and reduced the assessment rate when they're assessing borrowing. So when you go to a mortgage broker or you go to a bank for a loan, they're going to assess you at a rate that's normally 3% above whatever the standard variable interest rate is. But because what's happening with the rates going up so much and people finding it harder to borrow money, especially there's the term mortgage prisoners getting thrown around a lot, and they're guys that are stuck at their lender. They can't refinance out potentially to a cheaper rate because the assessment rate's too high. Well, they're starting to come down now, and I don't know what the internal dealings is with APRA, the regulator, but if Westpac are doing it, you could probably bet your bottom dollar that everyone else is going to follow. There's talk around of 35-year, 40-year loan terms. There's always been talk of that. It sounds like things are going to come into place. Actually, 35-year loan terms from a lender that was offering them before, they've made the servicing a lot more attractive. So you can see now this bull case starting to come through where finance is actually easy to get, money is easy to get, and if money is easy to get, people are going to spend more on properties. So that's a very simple bull case scenario. Let's move into what I actually think will happen. And the honest truth is, I don't know what will happen from here on in. I think the economy is in a pretty precarious position. What I think is that we're yet to see the full effects on the economy of rising interest rates. So what I mean by that, if borrowing powers have dropped by 40-50%, that actually means that 40-50% potentially less money is being created and put into the economy. So you can see here on this graph, by the way, I should clarify it, whenever you're getting a loan, whenever you're borrowing money, so that's whenever you're borrowing money for a home loan or when the government's spending more than what they earn through tax, which is basically all the time now, that money is getting created. So you've got to look at this graph and go, hey, I hope the money got created through the pandemic times. That's how we get That's how the prices of things go up. But what's happened now is a lot less money is being created. When those assets get sold, well, there's less money in the market to pay the higher prices. So I actually think that the property market isn't where we should be looking. I think that if the status quo remains the same, eventually we will get that scenario where properties come on the market, there will be an oversupply, and they will have to be sold off. Having said that, that actually takes a long period of time. And we aren't even at a point of oversupply yet. But if you understand the idea of that additional money going into the economy and then the additional money coming out because there's less money getting borrowed, that's not good news for business, because business rely on constantly more and more money. And that's how our economy works. It's a debt-based economy. So there's liquidity, there's money getting pulled out of the system. The threat here, in my opinion, is that if business starts losing profitability, it's going to affect unemployment. It's going to happen quick. And what that means is the value of shares are going to go down. The less profitable a business is, the less it's worth. It's pretty straightforward. Part of the inflation, I think, is businesses trying to protect themselves. They're raising prices to try and get more cash in because they see tough times coming. What they'll actually do when it gets close enough to the time is they'll start sacking people. And then you're going to get unemployment increasing. And when you get that, that's when governments step in. That's when they say, hey, we need to do something here. We can't have people losing their jobs. We need to provide stimulus. We need to reduce interest rates. So that's where it lies. Like, I just sit there and go, well, how long can our economy keep going before it cracks? We're pulling all this money out. Now, the question is, does the property market keep going along, or does the property market crack before that happens? At the moment, my money is on stocks actually crashing first. And it's a guess. It's an educated guess, but that's where I'm at. I've been watching this unfold, and honestly, if you told me this 9 months ago, I would have told you the property market's going to crack first. But I'm watching it. It hasn't cracked. Like I said, it's in the same spot. Let's see how things turn out. I think I'm going to wrap that up for today, guys. Once every quarter or so, these reports do come out. So we'll have the data available to basically see what's happening with the property market. Maybe I'll do some broader economic data so we can get a bit of an idea of how is the economy actually going, how are stocks actually going. I know that's not my area of expertise, but let's have a look at some data and tell us what's going to happen. Cheers.